Well, first and foremost, you want a stable investment team that has ample experience that is applicable to what they're doing. So you also want them to have a process that is clear, repeatable, and properly designed to achieve the outcomes. For example, you would want to make sure that the level of risk in the underlying securities and in the portfolio construction is aligned with what investors expect they're going to get. You also want a management team that is working in a company that has a culture that puts unit holder interests above their own. Right? A good way to judge that is to look at whether or not the investment team, is properly incentivized. Their incentives are aligned well with investors. A good way that firms do that, the best firms, they structure the remuneration package for portfolio managers and analysts to be based on performance over medium to long-term outcomes. And they also encourage managers and analysts to invest in units of the funds they manage. So that really helps align their incentives with investors very directly. So the bronze, silver, and gold represent levels of conviction that we have that the fund will be able to outperform either relevant market indexes or a relevant peer group. The ratings are based on our 5-pillar process, which really lines up to the characteristics I mentioned before about what you're looking for in a good fund manager. So the 5 pillars are people, process, parent, performance, and price. I think it's important to remember to point out that performance gets the lowest weight in the score. So we score each of the pillars, and performance actually gets the lowest weight in the overall score because past performance, as we know, is not a very good indicator of future performance. What's more important is looking at the team, how experienced they are, and how well everything is structured around the process. So they're forward-looking. They represent a level of conviction that we have that the fund can outperform, and they are based primarily on the team and the process and the culture that these investors are working in. That takes some analysis. First and foremost, it's important to remember that investing is risky. So, you have to be prepared for some tough performance times. In these times, I think it's really important to take a look at the performance and the strategy of the fund that you're in, and just make sure that the performance that has happened lines up with the strategy of the fund and what you might expect. So for example, if you're investing in an emerging markets fund that is well known for having Asian exposure, and they've had a tough couple of months as the Chinese market has sold off, the Asia market has sold off over the past couple of months, that might be something that you would expect, right? You should be prepared for some of that. If, however, you look at the performance and you think, wow, this is really not what I signed up for, then potentially you need to reevaluate. But I would say in the vast majority of cases, tough performance comes as a result of what you would expect with that type of strategy. And in those cases, we think it's important to just maintain a long-term investment horizon to the extent that you can and just sit tight.